Hey, Strategic Financial Group, Connor Mackey here, and today we're going to talk about two things that may impact your finances that have happened in the past 5 days. The first thing that we'll talk about is the Federal Reserve Board's decision to hold interest rates, and then the second thing is this trade deal that came out of nowhere between China and the U.S. So let's talk about the Feds first. On May 7th, the Feds came out, Powell came out, and he said, we're going to hold interest rates at the same rate that we've been holding them at. That's between 4.25 and 4.5%. Here's what you need to know about this. First, this is against what Donald Trump wants. President Trump would rather that Powell would lower rates, but Powell is doing this because he's looking at the volatility in the economy, in the market, and saying now is not the time to make a decision. He's moving slow and trying to make sure that he's making the right decision in the long run. If you don't know, interest rates are lowered at times of higher unemployment. So if unemployment numbers start to look bad, we lower interest rates. At the same time, if unemployment is sort of okay, but inflation is spiking, then you raise interest rates to bring costs down, or bring inflation down rather. Right now, Powell is concerned about both. He's concerned about what tariffs will do to inflation, while also concerned about what a recession may do to unemployment. So right now he's just holding the line. And here's what this has to do with your investments. If interest rates were to go up, then it is possible that your bond values, if you have bonds in your accounts, which many of you do, then your bond values would go down. And if interest rates were to go down, then your bond values would go up. Think of it this way. You lock in a bond, which is just you're giving debt, or you're buying debt from a company, and what they're saying is we're going to take $1,000 of your dollars and we're going to hold on to it for a year, and you're going to accrue interest during that time. Say it's 5%. So 5% over a year would be $50, right? And then at the end of that year, we're going to give you that $1,000 back, right? That's a bond. It's a debt security. If interest rates were to go up, and you own a bond that is at 5%, and now interest rates are at 7% or 8%, well, nobody's going to buy your 5% bond. Well, they might, but they're going to buy it at a lower value, right? And so the value of your bond goes down. But if interest rates go down, suddenly your 5% bond is worth more, because new issue bonds that companies are putting out there, they're going to be lower than that 5%. So what we want to see when it comes to bonds is we want to see, hey, we locked in some bonds at a higher interest rate over here, and now we want to see interest rates go down so that the value of those bonds go up. That's what we want to see, but we also understand that it's not just about our own bond positions, it's about a decision that is best for the U.S. economy as well. So we are waiting every single time that the Fed makes their decision. We just sit there and we watch and we wait to see what they say, because it could have really good impact on our finances here. The second thing that we get to talk about is China. So there is this trade deal that seems to have come out of nowhere between the United States and China. And what's important to know is really two things. One, we went down from 145% tariff on Chinese goods down to a 30% tariff on Chinese goods. That's a huge drop, right? And so the markets are reacting in a way where they're saying, hey, things are back. We're back to normal. We're going to start buying into the markets again. As of May 12 at 10:56 a.m., today alone, the S&P is up 2.71%. People are buying into the markets. They're seeing this as a good sign. Year to date, the S&P is still down 1.46%. And while we don't like being down for the year, it's better than we were doing before, right? So this seems like really good news. But there's something really important, and this is the second thing that we need to keep in mind. This is not a permanent decision. It's a 90-day sort of ceasefire between the United States and China. And really what it's trying to say is, hey, we'll put a pause on most of the tariffs with the intention of maybe lowering them more later on, or finding some sort of deal that we can make between the United States and China. It's a 90-day pause. It's not a permanent thing. We don't know what's going to happen after those 90 days. And so again, we're coming back to this idea of volatility in the markets and in the economy. It's still all up in the air. And so we are watching the situation. We're making sure that we're on top of it. We're watching when the Feds come out and they say whether or not they're going to lower or keep or raise interest rates. We're watching those things. We're also watching these trade deals. Of course, we're not in the room, but we're still watching them. So if you have any questions, any comments, any concerns, please feel free to set a meeting. We'll make sure that we can talk you through things and what our thought process is. Again, Connor Mackey with Strategic Financial Group.